Imagine waking up. You grab your phone off a nightstand and you log into your banking app just to like pay a simple bill.
Right, something we all do every single day.
Exactly. But the screen loads and something is just wrong. Your account is frozen. Your entire life savings, your checking account, the money you used to buy groceries, it's all completely locked.
Oh man, yeah, that's terrifying.
Right. So you rush down to the nearest ATM, and there is already this chaotic, panicked line stretching around the entire block. And when you finally get to the front, you read a notice that just makes your stomach completely drop.
Temperature all capped.
Yeah, you are legally capped at withdrawing just 50,000 rupees.
Yeah.
It doesn't matter if you have 5 lakhs or, 50 lakhs in there. You get 50,000, period.
It's basically the absolute nightmare scenario for any depositor. I mean, it's pure, unfiltered financial terror. When that happens, rationality just completely goes out the window.
And the crazy thing is, this isn't some abstract hypothetical. This is exactly what happened to millions of people in March 2020 with Yes Bank.
Yeah, which is wild because at the time, they were one of India's absolute high flyers, like one of the fastest growing private lenders in the whole country.
But behind the scenes, they had this incredibly aggressive corporate lending strategy that had just completely unraveled their balance sheet, right?
No, totally. The reserve ran dry. The Reserve Bank of India, the RBI, had to step in with that brutal withdrawal cap just to stop a total hemorrhage.
And it took this massive, completely unprecedented rescue package led by the State Bank of India just to keep the doors from shutting permanently.
Which sent absolute shockwaves through the entire Indian economy. I mean, for the last 6 years, the global financial sector has been watching them like a hawk.
Right, analyzing every single quarterly result.
Exactly. The overarching question has basically been, are they just a zombie bank on government life support, or is a genuine, sustainable recovery actually possible?
Which brings us to our mission for you today. We are taking a deep dive into this really brilliant, highly detailed July 2026 article from FinShots.
Yeah, it's titled, Yes Bank's Turnaround Explained.
Right. We're going to tear down all the financial jargon and put this bank through the gauntlet to see if they've actually recovered. We want to help you understand the true underlying anatomy of a massive financial turnaround. Okay, let's unpack this.
So to really grasp the sheer mountain Yes Bank had to climb over the last 6 years, we first have to recognize that a bank is not, a normal business.
Right, it's not like selling shoes.
Exactly. The mechanics of failure and the mechanics of recovery, they just operate on a completely different plane of reality.
Let me pose a thought experiment to you, the listener. Think about a standard manufacturing company, like a car brand, for instance.
Sure, like if a car manufacturer has a catastrophic year.
Yeah, what does that practically mean? It usually means they design bad cars.
Yeah.
Or maybe they price them out of the market. And the physical inventory just sits on the lot, gathering dust.
Right, you can literally see the problem parked outside.
But a bank doesn't manufacture physical goods. They don't have a lot full of cars or warehouses full of smartphones. A bank's entire fundamental inventory is just, well, it's confidence.
It's an invisible inventory. I mean, when you hand over your hard-earned salary to a bank, you receive absolutely no physical product in return.
Just pixels on a screen showing a number.
Exactly. You are handing your labor over purely based on the psychological belief that it will be safe. And, that the bank will give it back to you the second you ask for it.
So when Yes Bank collapsed in 2020, they didn't just lose money. They burned down their only warehouse. They completely incinerated the trust.
And rebuilding a shattered balance sheet is, at the end of the day, it's just math. You can write down bad loans, you can accept government bailouts, restructure corporate debt.
Right, the math can be fixed in a boardroom.
Exactly. But rebuilding evaporated trust, that is a colossal psychological hurdle.
Right.
A multi-billion-dollar bailout does not magically make an everyday depositor feel safe enough to, deposit their paycheck there again.
So if trust is the ultimate metric, I guess the only way to earn it back is by proving you are a viable, functioning business, one that isn't relying on regulatory life support.
We need to see if they can actually generate real sustainable profits on their own.
And the data from
Yeah.
the first quarter of financial year 2027 provides a really compelling snapshot, right?
It does. For the first time since that terrifying 2020 crisis, Yes Bank crossed the 1,000 crore mark in net profit.
Wow.
Yeah, they hit 1,071 crore, marking a 33% increase year over year.
And if we look at their return on assets, or ROA, which is this vital metric that basically measures how much pure profit they manage to squeeze out of every single rupee they control, It improved significantly.
Yeah, it went from a frankly terrifying negative 7.1% during the depths of the crisis to a positive 0.9% today.
A mathematical pivot of that magnitude is just incredibly rare in the banking sector.
It really is.
But wait, let me push back on this on behalf of the skeptics out there. Because if I see a company that was functionally dead suddenly pull a massive, record-breaking profit out of thin air, my alarm bells start ringing.
Oh, completely. That's a natural reaction.
Like, are they just getting lucky with the broader stock market? Or are these profits being propped up by temporary accounting tricks? Like liquidating a bunch of old stressed assets and just masking it as operating income.
That skepticism is entirely warranted, and frankly, it was the primary criticism leveled against Yes Bank in the first few years following the 2020 rescue. Analysts thought it was all smoke and mirrors.
But the FinShot's analysis says otherwise, right?
Yeah, if we dig into their analysis of the specific mechanics of this recent quarter, the numbers tell a very different story. Their net interest income rose by 17.5%.
Okay, break down net interest income for us, because that sounds like the key to answering the skeptic's question.
Sure. Net interest income, or NII, is the absolute bread and butter of banking. It is basically the difference between the interest a bank earns from lending money out and the interest it pays to depositors who keep their money there.
So it's the core engine of a bank.
Exactly. If NII is growing rapidly, it means the core business of borrowing and lending is healthy. Furthermore, their operating profit jumped more than 25%.
Wow.
And the critical context here is what did not contribute to that jump.
Right. The FinShots piece points out that this growth happened despite a sharp fall in Treasury income and a significant drop in recoveries from old, bad loans.
Yeah, the management explicitly noted that. So the data confirms they aren't relying on one-off windfalls or accounting tricks anymore.
They are making real sustainable cash from the actual boring everyday business of taking deposits and underwriting good loans.
Exactly, just doing normal bank stuff.
That being said, we shouldn't start building statues of their management team just yet, right?
No, definitely not.
Because a 0.9% return on assets is a monumental leap from negative 7.1%. But they still significantly lag behind the heavyweights of the Indian private sector.
Yeah, giants like HDFC and ICICI routinely boast ROAs of over 1.5%.
So Yes Bank is out of the ICU, but they still have a massive gap to close to match the profitability of their strongest peers.
Right, and if we connect this to the bigger picture, generating a profit on a spreadsheet is excellent, but a bank can't survive in the long run without raw materials. And a bank's raw material is, well, other people's money.
Other people's money, exactly.
If trust is truly returning, we shouldn't just see profits. We should see everyday people willingly handing over their savings again.
Which means we need to look at the money flowing in. And in Q1 FY27, Yes Bank's deposits grew by more than 14%, reaching over 3.15 lakh crore.
That's a huge metric.
And advances, which are the loans they're confidently handing out, also grew by 18%.
Yeah, which tells us that not only are depositors feeling safe, but borrowers are comfortable committing to long-term financial relationships with the bank.
But here is the real secret sauce. It isn't just about the sheer volume of deposits. It's about the flavor of those deposits. We are talking about CASA.
Current and savings accounts. The undisputed lifeblood of any stable financial institution.
I like to think of CASA like a highly valuable, low-churn subscription base for a tech company.
That's a really good analogy, actually.
Right. If you're running a bank, the money sitting in people's everyday checking and savings accounts is incredibly cheap raw material. You barely have to pay out any interest on a checking account.
And human nature dictates that people tend to just leave their money parked there for years because, honestly, moving it is a huge hassle.
Exactly. It's reliable, sticky, cheap money. Compare that to a fixed deposit where you might have to pay out 7 or 8% guaranteed interest.
Yeah, it's way more expensive for the bank.
Yeah.
And Yes Bank's CASA ratio currently stands at 32.7%, but the underlying demographic of that number is what really matters.
Yeah, the retail side.
Yeah. Retail and branch deposits, meaning money from everyday individuals and small local businesses, now make up nearly 60% of their total deposits.
Why is that 60% retail number such a massive deal for their survival, though?
It completely revolutionizes their risk profile. Before the 2020 crisis, Yes Bank was heavily dependent on a handful of massive, whale-sized corporate depositors.
And when you rely on whales, you are incredibly fragile.
Extremely. If just one or two of those corporate giants catch a bad rumor and decide to yank their funds, it creates an instant catastrophic liquidity crisis. The vault is suddenly empty.
So by democratizing their deposit base, they've traded a few unpredictable whales for millions of steady minnows.
Exactly.
If 100 retail customers panic and withdraw their funds, it's a drop in the ocean. The bank barely feels it.
The foundation is just vastly more resilient now.
Okay, having a mountain of cheap, sticky deposits flowing in is fantastic. But let's be honest, the entire reason they crashed and burned in 2020 wasn't because they couldn't attract deposits.
No, not at all.
It was because of the incredibly reckless things they did with those deposits once they had them. We have to look at the dark side of the ledger. Are they actually lending this new money responsibly?
To evaluate their lending discipline, we have to look closely at their non-performing assets, or NPAs.
Right.
In banking terminology, an NPA is a loan where the borrower has failed to make a principal or interest payment for 90 days. It is the ultimate flashing red light on a bank's dashboard.
And during the peak of their crisis, Yes Bank's net NPAs were sitting at a mind-boggling 16.8%.
Which is just, to put 16.8% into visceral perspective for you, imagine you lend money out to 100 different people. Now imagine that almost 17 of those people completely ghost you.
Just totally disappear.
Yeah. They stop answering your calls and that money is just gone. For a bank, which operates on razor-thin margins of just a few percent, losing 17% of your loan book isn't just a bad quarter, it is a terminal diagnosis.
But let's look at the numbers today. Gross NPAs have plummeted to just 1.3%.
Incredible drop.
And their net NPAs, the absolute core bad debt, are at a microscopic 0.2%. That means out of every 1,000 borrowers, only 2 are defaulting.
Yeah, it's a massive turnaround.
But hold on, I need you to explain the mechanics of this, because how on earth do you make tens of thousands of crores in toxic debt just vanish?
It doesn't just disappear on its own, that's for sure.
Right. You don't just tighten your underwriting standards and magically erase historical bad loans. You have to do something drastic. I've always thought of their 2022 strategy like a homeowner who has hoarded decades of toxic, rotting garbage in their living room. You cannot start a fresh renovation while tripping over hazardous waste. You have to rent a massive industrial dumpster, throw all the junk in there, and haul it away so you can finally start fresh.
That is a highly accurate way to describe the mechanics of an asset reconstruction company, or an ARC.
Okay, tell us about the ARC.
In 2022, Yes Bank took nearly 48,000 crore worth of those older, toxic NPAs and transferred them out of the bank entirely. They handed them over to J.C. Flowers Asset Reconstruction Company.
So they literally haul the garbage to the dump.
Yeah.
But they didn't just get off scot-free, right? What is the catch here?
The catch is what the financial industry calls a haircut. When a bank transfers 48,000 crore in bad loans to an ARC, the ARC doesn't pay them 48,000 crore for it.
Obviously not, yeah.
Right, the ARC knows this is toxic debt that will be incredibly hard to collect. So the ARC buys that debt for pennies on the dollar. Yes Bank had to accept a massive, painful loss on their balance sheet to make this transfer happen.
They took the financial hit up front just to get the poison out of their system.
Exactly. They absorbed the pain to buy themselves a clean slate. By offloading that toxic baggage, the bank's management team was no longer waking up every single morning just to fight old fires and chase down deadbeat corporate borrowers.
That makes total sense.
It freed up massive amounts of capital and intellectual bandwidth, allowing them to dedicate 100% of their energy to writing new, healthy loans. What's fascinating here is how fundamentally they altered their entire lending philosophy the moment that slate was clean.
Right, because pre-2020, they were doing the exact same thing with their loans as they were doing with their deposits, chasing the whales.
Yes, they were notoriously dependent on a few massive corporate conglomerates.
If one of those mega corporations went bankrupt, it left a smoking crater in Yes Bank's balance sheet.
But today, the strategy has completely flipped. Retail and SME, small and medium enterprise loans, now account for nearly 60% of their total loan book.
Wow.
Yeah, if we rewind to financial year 2020, that number was sitting at roughly 36%.
So they took the exact same diversification strategy they used to fix their deposits. and applied it to who they lend money to.
Exactly.
Spreading their capital across hundreds of thousands of smaller, everyday retail and small business loans is infinitely less risky than placing massive, concentrated bets on a few corporate titans.
It relies heavily on the law of large numbers. 100 small, individual defaults barely dent a bank's armor, but one massive corporate default can pierce the heart of the institution. They have engineered a much more resilient shield.
Okay, so we've established that they use the ARC to clean up the sins of the past, and they've diversified their loans to protect the present. But banking is a forward-looking game.
It always is.
The economy is cyclical, which means there is always another macroeconomic storm brewing on the horizon. How is Yes Bank preparing for the next crisis?
Well, the absolute first line of defense against any economic storm is a bank's capital buffer. Even the most brilliantly managed, conservatively run banks will inevitably see some loans go bad during a global recession.
It's unavoidable.
Right. The crucial question is whether they have enough raw capital set aside in the vault to absorb those inevitable losses without ever threatening the money that belongs to their depositors.
The regulatory requirement, like the bare minimum floor that the RBI dictates a bank must hold, is a capital adequacy ratio of 9%. Where does Yes Bank sit today?
As of the first quarter of financial year 2027, they are sitting at a highly robust 15.1%.
Okay, so well above the requirement.
Yeah, they have constructed a very meaningful shock absorber against future volatility.
Here's where it gets really interesting, though. When we talk about this capital buffer and future-proofing the institution, we have to talk about their new strategic investor.
Ah, yes. SMBC.
Japan's Sumitomo Mitsui Banking Corporation, or SMBC. They stepped in and took a commanding position as Yes Bank's largest shareholder. But the FinShots article highlights a massive, crucial caveat regarding the mechanics of this deal that I think a lot of casual observers completely miss.
Yeah, the mechanics of the SMBC deal are vital to understand. SMBC did not inject fresh capital into Yes Bank.
Really?
Nope. They did not write a giant multi-billion-dollar check directly to the bank to pad their vault. Instead, SMBC bought their substantial stake from existing shareholders.
Oh, interesting.
Yeah, they bought out entities like the State Bank of India and the other domestic consortium banks that had originally bailed Yes Bank out in 2020.
Wait, let's pause on that. If SMBC just bought out existing shareholders, then on a purely mathematical level, Yes Bank itself didn't actually get any new money to play with.
Correct.
The capital buffer of 15.1% wasn't magically inflated by Japanese money. So why is everyone treating this as the ultimate victory for Yes Bank?
Because they traded reluctant, forced saviors for an eager strategic partner.
Okay, I like that phrasing.
Right. It was an injection of psychological capital. When SBI bailed them out in 2020, it was out of necessity to save the Indian economy from a domino effect.
They didn't really want to be there.
Exactly. But when a global powerhouse like SMBC voluntarily buys in, it signals to the entire global market that the turnaround is genuine. It proves that a massive conservative Japanese institution looked at the books, analyzed the risk, and decided Yes Bank was a lucrative long-term bet.
It's the ultimate stamp of approval.
It really is.
But that brings us to the final and, frankly, the most difficult piece of this entire puzzle. Culture.
Ah, yeah.
The invisible metric.
Right. You can clean up financial ratios on a spreadsheet, you can offload toxic debt to an ARC, you can mathematically tweak your CASA ratios, and you can lure in a global investor. But culture, the aggressive risk-taking, growth-at-all-costs cowboy mentality that created the 2020 disaster in the first place, that doesn't show up on a balance sheet.
It really doesn't.
How do we know for an absolute fact that the toxic culture of the old management is dead and buried?
It is arguably the hardest metric to quantify because corporate culture is largely invisible right up until the moment it destroys the company.
However, the structural indicators we do have point to a systemic root and branch shift. First and foremost, the management team that presided over the 2020 crisis has been entirely eradicated.
Good to know.
Yeah, they completely swept the C-suite. Second, we can look at independent credit rating agencies. Their entire business model relies on sniffing out hidden risks and toxic cultures, and they have consistently upgraded Yes Bank, initiating highly favorable ratings.
But the real cultural anchor here comes back to SMBC, doesn't it?
Without a doubt. Because SMBC didn't just buy up a bunch of shares and passively monitor the stock price from Tokyo, they actively nominated their own senior, highly experienced risk executives to sit directly on Yes Bank's board.
What does a risk executive actually do in this context, like on a day-to-day basis?
They sit in the most important committee meetings, they review the loan portfolios, and they actively inject global, rigorous risk management protocols directly into the DNA of the bank's decision-making process.
Do they have real power?
Absolutely. Their primary mandate is to be the adults in the room. When a charismatic executive proposes a highly lucrative but incredibly risky loan to a corporate giant, the risk executive is there to firmly say no.
Because they aren't going to let Yes Banks slip back into its old reckless habits, since SMBC's own billions are on the line now.
Exactly. Their incentives are perfectly aligned toward caution. But this raises an important question regarding culture. The true test of this newly reformed risk culture isn't how the bank behaves right now, while the Indian economy is growing steadily and everyone is on their best behavior under the spotlight.
Oh, totally. It's incredibly easy to brag about your tight underwriting standards when everything is sunny and borrowers are flush with cash.
Right. Anyone can look good in a bull market.
But the real test happens when macroeconomic growth stalls. When recession hits and the immense pressure mounts from Wall Street and Dalal Street to hit quarterly profit targets, what happens behind closed doors?
That is the multi-billion-dollar question.
Do they hold the line on risk? Or do they quietly start bending the rules, slipping back into aggressive, high-risk corporate lending, just to juice the numbers and keep the stock price up?
The ultimate proof of a successful turnaround is enduring a severe crisis without reverting to the very habits that caused your previous near-death experience. We won't know if the culture is permanently fixed until they navigate the next downturn.
So let's bring it all home. Let's look at the grand verdict based on everything we've synthesized from this FinShots deep dive and the underlying data. Has Yes Bank actually recovered?
Well, the answer appears to be a resounding yes.
But with a prominent asterisk.
Yeah, always an asterisk.
They have successfully survived an existential collapse that, by all rights, should have killed them. They've taken the haircut to clean the toxic garbage out of their balance sheet. They've fundamentally diversified their risk away from corporate whales, and they are generating genuine core banking profits.
They definitively won the first battle, which was simply the battle for survival. But as the analysis suggests, the verdict is still out on whether they can ever reclaim their former status as a premier, fiercely competitive private bank operating on the same level as the untouchable giants of the industry.
Because turnarounds are only truly successful when an institution evolves from just being a cleaned-up bank into being a fiercely sustainable, continuously growing business.
Exactly. Surviving isn't the same as thriving.
So what does this all mean for you? We've spent this entire deep dive exploring how a bank's ultimate fundamental inventory is trust. The entire foundation of Yes Bank's survival rested on convincing consumers to feel confident enough to leave their paychecks in those accounts.
Trust is everything.
But I want to leave you with a lingering thought today, something that wasn't strictly in the quarterly profit numbers, but builds entirely on this fragile concept of trust.
Okay, let's hear it.
Think about how a classic bank run happened in the past. People literally lined up around the physical building. You could see the panic with your own eyes, and it moved at the speed of walking feet and word of mouth.
Right, which gave them time to react.
Exactly. That physical friction gave regulators and bank managers hours, sometimes even days, to respond, make statements, and calm the public down. But today, we live in an entirely frictionless digital era.
Oh yeah, things move way faster now.
If a rumor starts today, a bank run doesn't happen with a physical line around the block. It happens in milliseconds. It happens via smartphone apps, driven by social media algorithms pushing rumors directly to your feed and panic spreading through private WhatsApp groups.
It's terrifying when you think about it.
Millions of people can withdraw billions of dollars with a tap of their thumb from their living room couch. So how does any modern bank, even a brilliantly recovered one like Yes Bank, truly future-proof their trust when a multi-billion-dollar existential panic is just one viral post away?
That is the new reality they have to face.
It is a brand new, incredibly volatile world for banking, and the speed of trust is faster and more fragile than ever before. Thank you so much for joining us on this deep dive. Keep questioning the numbers, keep looking for the why behind the headlines, and keep exploring. We'll catch you on the next one.